The next market crash isn't a matter of if, but when. And if you're retired, that crash could cost more than just dollars. It could cost your peace of mind. But it doesn't have to. Market crashes are part of the ride. They've always been. History has taught us some hard lessons. The 2008 financial crisis wiped out over $2 trillion in retirement savings. More recently, the 2020 COVID crash sent markets plummeting 35% in just 33 days. But you know what else happened? Recovery, every single time. In this video, we're breaking down how retirees can survive and even thrive through the next big downturn. With recession-resilient strategies like smart asset allocation, flexible withdrawal plans, and proven timing techniques, you'll learn how to keep your retirement income intact, even when markets fall apart. Market downturns are inevitable, but financial devastation isn't. Let's dive into how the smartest retirees are preparing right now, before the storm hits. When market storms approach, your first line of defense is how your money is positioned. Think of your retirement portfolio like a house. You don't just need a roof, you need walls, a foundation, and utilities designed to withstand different threats. This is where the bucket strategy comes in. Instead of lumping all your retirement savings together, smart retirees are creating 3 distinct buckets that serve different purposes during market volatility. Let me introduce you to Richard and Carol, both 68, who restructured their portfolio after getting burned in the 2008 crash. They created 3 distinct buckets. Bucket 1 held 2 years of living expenses in cash and cash equivalents, money they could access without selling investments. Bucket 2 contained 3 to 8 years of expenses in short-term bonds and defensive divided stock investments that could recover relatively quickly after a downturn. And Bucket 3 held their longer-term growth investments, the money they wouldn't need to touch for nearly a decade. When the 2020 COVID crash hit, they had a simple plan: draw exclusively from Bucket 1. This gave their other investments time to recover. The result? While their friends were selling stocks at 30% losses, Richard and Carol actually increased their net worth by 12% over the following 2 years. So, what's the right mix for you? Morningstar research shows that retiree portfolios with a 20-30% cash buffer experienced 25% less volatility during the 2008 financial crisis. But don't swing too far in the other direction. According to Vanguard's research on tactical asset allocation, abandoning equities completely is one of the biggest mistakes retirees make during downturns. For most retirees in their 60s, consider keeping 1 to 2 years of expenses in cash, 3 to 5 years in bonds and defensive dividend stocks like consumer staples and utilities, and the remainder in a diversified mix of equities. The older you are, the more you'll want to shift toward those first 2 buckets. Remember this: market crashes don't last forever, but bad decisions can permanently damage your retirement. Now, let's talk about what happens when you actually need to take money out of your retirement accounts during a downturn. How much you withdraw, and when you withdraw it, can make a world of difference. Most retirees are familiar with the traditional 4% rule. Withdraw 4% of your portfolio in year 1, then adjust that amount for inflation each year after. It's simple, but it has a fatal flaw. It assumes the market goes up in a relatively straight line. And we all know that's fantasy, not reality. This is where flexible withdrawal strategies come in, approaches that adapt to market conditions rather than blindly following a formula created during the greatest bull market in history. Let's look at Janet, a 72-year-old retiree with a $1.2 million portfolio who typically withdraws $48,000 annually. That's her 4%. When the market dropped 22% in early 2020, she didn't stick stubbornly to that number. Instead, she implemented what financial planners call a guardrails approach, temporarily reducing her withdrawals to $4,800, a 15% reduction. Now, I know what you're thinking. Cutting your income during retirement sounds painful. But Janet was strategic. She focused on cutting discretionary expenses like travel and dining out while maintaining essential spending. She also withdrew primarily from her bond allocations, which remained relatively stable, preserving her equity positions for the recovery. By not selling equities during the downturn, Janet's portfolio recovered fully by 2021. The best part? She was able to resume her normal withdrawal rate and even take a catch-up trip to see her grandchildren that she had postponed. William Bengen, the creator of the original 4% rule, has updated his own research to show that dynamic withdrawal strategies can actually increase lifetime spending by 10 to 20% compared to rigid formulas. And the updated Trinity study found that retirees who reduced withdrawals by just 10% during market corrections improved their 30-year success rate by nearly 30%. The hardest part isn't the math, it's the emotional challenge of temporarily cutting back. The key is having a plan before the downturn hits, knowing exactly which expenses you'll trim first, and reminding yourself that this adjustment is temporary. Your future self will thank you. If there's one lesson from every market crash in history, it's this: don't put all your eggs in one basket. This is especially true for your retirement income. Relying solely on portfolio withdrawals for retirement income is like building a table with just one leg. It might stand when everything's perfectly balanced, but add any pressure and down it goes. Let's look at how successful retirees are diversifying their income sources to create stability during market turbulence. Meet Michael, a 66-year-old former marketing executive who built 5 distinct income streams before the 2020 market drop. First, he optimized his Social Security claiming strategy for maximum benefits, waiting until age 70 for a 32% boost over his full retirement age benefit. Second, he allocated 20% of his portfolio to a qualified longevity annuity contract, or QLAC, creating a guaranteed income stream starting at age 75. Third, he maintained a small marketing consultancy serving 2 steady clients, working just 10 hours a week doing what he enjoyed. Fourth, he invested in a dividend aristocrat ETF, focusing on companies with 25-plus years of dividend increases, companies that have maintained or increased dividends even during recessions. And fifth, he rented out a small apartment above his garage through Airbnb, creating another $1,000 monthly in relatively stable income. When the market crashed, Michael's investment portfolio dropped by 28%, but his overall income decreased by only 7% thanks to these diversified sources. The peace of mind allowed him to avoid panic selling and maintain his long-term investment strategy. The BlackRock Retirement Institute found that retirees with 3 or more income sources report 1.6 times higher retirement satisfaction than those with just 1 or 2 sources. And research on dividend aristocrats shows they've outperformed the S&P 500 by an average of 1.9% annually during recession periods since 1990. The best time to diversify your income isn't during a crash, it's right now. Start by identifying skills you could monetize part-time, researching dividend-focused investments with consistent payment histories, and exploring whether a small portion of guaranteed income products might make sense for your situation. Remember, income diversity isn't just about money, it's about sleeping well at night when markets go crazy. Let's get real for a moment. The biggest threat to your retirement during a market crash isn't the market itself, it's the person in the mirror. The decisions you make when your portfolio drops 3% a day will impact your financial security for decades to come. Our brains weren't designed for investing. They were designed to keep us alive in the wilderness, to react quickly to threats, to follow the herd, and to avoid pain at all costs. These instincts served our ancestors well, but they're terrible for managing retirement accounts. Consider Barbara, a 70-year-old retiree who panicked during the 2008 financial crisis. When her portfolio dropped 40%, her fight-or-flight response kicked in, and she sold 60% of her equity holdings near the market bottom, locking in substantial losses. But Barbara's story doesn't end there. Before the 2020 COVID crash, she worked with a financial advisor to create something revolutionary, a written market volatility plan that detailed exactly what actions she would and wouldn't take during a downturn. When the market plunged in March 2020, instead of panicking, she followed her predetermined plan. She restricted herself to checking her portfolio only once weekly, scheduled a call with her advisor before making any changes, and focused on her guaranteed income sources like Social Security. Despite initial anxiety, she adhered to her plan, kept her allocations intact, and her portfolio fully participated in the subsequent recovery. The emotional difference, she reports, was night and day compared to 2008. Dalbar studies consistently show that the average investor underperforms the market by nearly 4% annually due to emotional decision-making, buying high and selling low. For retirees, this behavioral gap is even worse, with research showing heightened loss aversion after age 60. Here are 4 practical techniques to maintain discipline during market stress. First, implement a 72-hour rule before making any major portfolio changes, no exceptions. Second, create a pre-written market crash action plan during calm times, just like Barbara did. Third, consider working with a fiduciary financial advisor whose job is partly to serve as an emotional buffer. And fourth, limit consumption of financial news during volatile periods. Checking headlines once a day is plenty. Write this down. My plan is sound. I've prepared for downturns. I don't need to act emotionally. Keep it next to your investment account login information. Sometimes the best investment strategy is simply not messing up a good plan. Market crashes aren't just threats, they're opportunities. While most people are running for the exits, the smartest retirees are looking for ways to come out stronger on the other side. Let's be clear, I'm not talking about buying the dip with money you need for next year's expenses or making speculative bets on beaten-down stocks. I'm talking about strategic moves that take advantage of temporary market dislocations while managing risk appropriately. During the March 2020 market crash, 67-year-old Robert executed a strategic Roth conversion of $100,000 from his traditional IRA when his investments had temporarily dropped by 30%. This was brilliant timing, converted a significantly larger number of shares than he could have at higher valuations, while paying taxes on the reduced amount. As the market recovered, those assets grew tax-free in his Roth IRA. But Robert didn't stop there. He also implemented an opportunistic rebalancing strategy, shifting some of his bond allocation to high-quality stocks that had been disproportionately punished in the panic selling. By December 2020, this tactical move had added approximately $42,000 in additional portfolio value compared to maintaining his regular annual rebalancing schedule. Research from Michael Kitches shows that Roth conversions executed during market downturns can provide up to 30% more after-tax wealth over a retirement lifetime compared to conversions during market peaks. And Morningstar found that disciplined rebalancing during the 2020 market correction added an average of 2.4% in excess returns over a static approach. So, what opportunistic strategies should you consider before the next downturn? First, identify candidates for potential Roth conversions and calculate the tax implications in advance. Second, implement systematic tax loss harvesting to offset future gains. Third, create triggers for opportunistic rebalancing beyond your standard schedule, perhaps when market segments decline by specific thresholds. And fourth, maintain a small opportunity fund specifically earmarked for purchasing income-producing assets at discounted values. The key is preparation. These strategies only work if you've thought them through before emotions take over. Have your plan ready, discuss it with your financial advisor if you have one, and be prepared to act decisively when others are frozen by fear. As we wrap up tonight's retirement report, let's review the 5 key strategies that can help you not just survive, but potentially thrive through the next market downturn. First, implement a defensive asset allocation using the bucket strategy, ensuring you have 1 to 2 years of expenses in cash and another 3 to 5 years in stable investments. Second, prepare to adjust your withdrawal strategy when markets decline, using a flexible approach rather than rigidly following formulas created during bull markets. Third, diversify your income sources beyond just portfolio withdrawals, creating stability when markets become volatile. Fourth, develop an emotional discipline plan before the crash happens, including specific guardrails to prevent panic selling. And fifth, identify opportunistic strategies you'll implement during downturns. From Roth conversions to strategic rebalancing, your next steps? Take a hard look at your current retirement plan and ask yourself, if the market dropped 30% next month, what exactly would I do? If you don't have a clear, specific answer to that question, use the strategies we've covered tonight to develop one. Remember, markets go up and markets go down. But smart retirees don't just survive crashes, they position themselves to thrive after them. Build the buffer, balance your risk, and stay steady when the world shakes. If you found this information valuable, hit that subscribe button to catch all our Retirement Report episodes, and leave a comment below with your #1 worry about the next market crash. I read every comment and used them to plan future episodes. Until next time, stay informed, stay prepared, and remember, it's not just about having enough for retirement, it's about having enough no matter what the market throws your way.